Many trading strategies rely on a cluttered setup of moving averages, RSI, and MACD. To understand how the market actually moves, we have to look at the chart without them. This is the raw data of the market. Standard indicators use past price data as their input, which makes them inherently lagging. By the time an indicator gives a signal, the price has often already completed its move. Analyzing the candlesticks as they form provides information in real time. Price action trading focuses on three specific variables: price, volume, and structure. Markets move through four distinct phases. Accumulation occurs at the bottom when price consolidates. This is followed by the advancing phase, where the price trends upward. Once buying peaks, the market enters distribution at the top, before eventually entering the declining phase. We define these trends mathematically. In an uptrend, the price prints a higher high followed by a higher low. Conversely, a downtrend consists of lower highs and lower lows. Recognizing these structures allows a trader to anticipate the next probable move based on the current market cycle, rather than reacting to delayed signals. A common error in technical analysis is drawing support and resistance as single, thin, horizontal lines. When price approaches an exact line, it often wicks slightly below it. This movement activates the sell stop orders placed by retail traders just under that line. Once those stops are hit, the price often reverses and continues the original trend. Mapping an area of value, a shaded zone covering both the candle bodies and the wicks, provides a more accurate representation of where buying and selling pressure actually sit. This zone accounts for the volatility that a single line ignores. Instead of memorizing dozens of candlestick patterns, we analyze the specific behavior of price as it enters these zones. A full-bodied green candle indicates that buyers maintained control from open to close. However, a candle with a long lower wick shows that sellers initially drove the price down, but were met with enough buying volume to force the price back up before the candle closed. This aggressive rejection inside an area of value is a high probability signal. Because retail traders lack the capital to reverse a price move that quickly, this type of rejection usually signifies that institutional orders, which have the volume necessary to move the market, have entered at that specific price level. Trading gets complicated when different timeframes provide conflicting signals. In these cases, the higher timeframe dictates the primary direction. Here, the 15-minute chart shows a series of lower highs and lower lows. On its own, this looks like a downtrend. But when we look at the 4-hour chart on the left, we see this decline is a small pullback within a much larger uptrend. We wait for the 15-minute price action to break its local downward structure. When the smaller timeframe begins printing higher highs again, it aligns with the 4-hour trend. In this scenario, a massive green candle surges directly into a resistance zone. Should you buy the momentum or wait for more data? Buying an aggressive move directly into resistance is risky. The price is already overextended, meaning the move is exhausted. Because the entry is so far from the nearest support, your stop loss will have to be excessively wide to survive a reversal. Professional traders avoid entering on aggressive surges. Instead, they wait for the price to stabilize and form a new structural base, or a pullback before committing capital. To put these concepts into practice, we begin with the macro context. This 4-hour chart shows a consistent uptrend, with higher highs and higher lows. We map our area of value at the previous swing high and wait for a pullback. A Fibonacci tool shows the price has retraced into the 0.5 to 0.618 zone, which provides a logical area for buyers to re-enter. Dropping down to the 15-minute chart, we look for a trigger. As the price enters the zone, a bullish engulfing candle forms, signaling that buyers have regained control. We enter the trade at the close of this candle. We place the stop loss slightly below the entire demand zone to account for potential wicks. The take-profit target is set at the previous swing high. The trade follows the higher timeframe trend until the target is reached. This strategy follows 5 steps. Use naked charts, draw zones instead of lines, wait for the price to reach an area of value, look for candle rejection, and hide your stop loss behind market structure. Success in price action comes from the disciplined application of these structural rules. Indicators will always be a secondary calculation of the past, but price is the immediate record of the market's current supply and demand.